Good afternoon, everybody. So just to start off with, I'm essentially going to walk through kind of the problem that we're actually solving. Why Lending Loop exists, why Lending Loop came to market in Canada, and kind of move forward from there into actually looking at a bit of our story, but more importantly, some other jurisdictions, especially because this is kind of focused from a regulatory perspective. Wanted to kind of focus on how other jurisdictions have been addressing some of the issues in our particular business model. Just to start off with, this is kind of the market dynamic that we're faced with today. Borrowing costs are at an all-time low, yet at the same time, yield for banks is at an all-time high. And I think Michael kind of spoke to this, not just in terms of where yield's been so far and where return has been so far, but also in terms of some of the bank targets and bank practices. And talking about specifically talking about banks, some of the issues are, and I'm sure most of you are highly aware of this. They're an oligopoly, which is obviously harmful to consumers. There is a moral hazard for the economy, which we've seen a number of times, not necessarily only in Canada, but more so in other jurisdictions. And also, speaking specifically to what we do, which is small business lending, there's an unwillingness to serve smaller loan volumes because they make more profit in other areas. So kind of the sentiment is why go after less profitable segments when we can focus on what makes the most money for our business. And to really pinpoint the problem for customers, looking at our borrowers, if you have banks on the one side and kind of traditional alternative lenders on the other side, you've got this paradigm where you can either get a loan from a bank and wait 60 to 90 days, or you can go to an alternative lender, but you're going to end up paying a lot more money. And really the problem that we're trying to solve for borrowers at Lending Loop is kind of giving people access to low cost or prime credit in a very fast and efficient manner. At the same time, lenders or savers in today's environment also have a problem. Inflation is about 1.3%, and you get 0.95% on a GIC. So, if you're looking at, the traditional retail investor in the market today, aside from public equities, there's not a whole lot of investment opportunities. And what we're starting to see in other jurisdictions is that this type of asset class is one that's very attractive for that retail investor, and one that we're seeing, a lot of people actually move their money out of traditional deposit-taking institutions and into, a medium risk asset class like this. So what is peer-to-peer lending? What do we actually do? It's an online credit marketplace that connects those people, those savers or those investors who would traditionally put their money into savings accounts with borrowers who are looking for capital, looking for credit. By doing this online and doing it in a more efficient manner, borrowers are actually able to receive more affordable debt financing than they would be able to through a bank. And similarly, lenders can actually receive a higher return on their investment because they're taking a piece of that spread that I showed on the first slide. In terms of how companies like us make money, so just to kind of speak to our profit model and how it actually works, we really have two main origination streams of capital. One is that origination fee, which is an upfront fee that you'll take from a borrower. It's not too dissimilar from what a bank would charge in terms of a setup fee. And we'll also take a spread between the borrowed and invested interest rates. So just to kind of speak to why this asset class or why this is actually is important, and I think like this slide really illustrates it very well for myself. If you look at a traditional lender or a bank lender, the streams that capital has to go through is, first through bank warehousing, then it will go through an issuing or an investment bank. It will then go to the traditional capital markets. Then it will go through typically like a pension fund or insurer before actually landing up in the hands of the customer or the investor. Versus through a P2P lending platform, it's going direct from A to B. And doesn't take a genius to know that structure is a lot more efficient, and it's one that's only been really able to be done through recent times, through the advent of things like technology that can actually connect the borrowers and the investors together. That intermediation is a tax on capital, it's a tax on individuals, it's a tax on savers, and it's the reason that in the financial system today you have that paradigm where savers are actually earning less than the rate of inflation. And you can actually see here, this was a McKinsey study that was done just on that exact point of efficiency, looking at Lending Club, which is a US platform versus a bank competitor, and they showed that there's actually a 220 basis points advantage for Lending Club over a traditional bank. And another point to mention is that this is actually a proven asset class. I mean, in Canada, we're a very new platform. We got our regulatory approval actually just in October 2016, but this has actually been around for 12 years in the UK. So there's a lot of data behind it. We've seen Prosper, which is one of the US platforms, showing consistent growth that's similar to the S&P 500. Or in the UK, there's actually a publicly listed fund called the Funding Circle SME Index Fund, which is a fund that just trades on this type of asset class. And I think, looking at it from a policy maker's perspective or from a regulatory perspective, The group that we're targeting, and Troy's obviously going to talk to this as well in his presentation, is one that's been traditionally very underserved, but one that's very, very important. If you look at SMEs in Canada, they're about 90% of the private labor force. They contribute about 27% of Canada's GDP. And actually, from a credit or a risk perspective, jobs in small businesses were the least affected in the 2008 recession. So while a lot of people look at it as a very risky asset class, we have a bit of a different perspective on kind of these types of borrowers. So as I said, I kind of want to go a little bit into an international perspective just to talk to how other people in other jurisdictions have addressed this exact market. So if we look at the UK and the US and the platform growth there, we can see a few platforms in the UK who have originated over £2 billion of credit to these platforms. And in fact, Mark Carney, the governor of the Bank of England, gave an address earlier this year, I think it was in January, and he said 20% of all new SME lending is coming through Funding Circle, which is just this one platform here. So I think we are really starting to see quite a bit of disruption in this particular space, just given how these traditional incumbents have not served these borrowers very well. And in the US as well, you can also see like total loan issuance in Lending Club has been almost $25 billion over the last 10 years. So these are significant numbers. These are numbers that are really playing disruptive forces in the industry. Yet when you look at Canada and you look at kind of the makeup of the platforms here, in the UK you have about 100 plus platforms that are connecting retail customers or retail savers or depositors to people who are looking for financing. Versus in Canada, I think, to my knowledge, we've only seen about 2 different companies, one being us, one being ATB Bank, actually, who's just primarily focused in Alberta, who's connecting their members to small businesses that are looking for capital. It's obviously a very different paradigm when you look at Canada versus the UK. So I'll kind of talk very briefly on the history of the UK through a different, I know Michael actually gave a perspective on the UK, at a high level. I'll just speak to specifically on the P2P lending side. So if you look at 2005, this is when P2P lending first started. Zopa first launched essentially what became the first ever P2P lending platform. I think it was called social lending or crowd lending at the time. In about 2011, so 6 years after Zopa first launched, there were a few more platforms that popped up, and there was no real regulation around what they were doing. So what they did is they created a regulatory organization that would regulate themselves called the Peer-to-Peer Finance Association, quote unquote, to promote high standards of conduct and consumer protection. Through the process from about 2005 to about 2014, the FCA, who's kind of responsible for consumer protection, was actually taking visits and actually looking at these business models very closely. So they were spending a lot of time sitting down with the business owners, actually going into these companies and doing site visits to actually see what was going on in these companies before applying regulation. And then in April 2014 was the first time that the FCA published their new rule book in terms of how they would actually regulate P2P lending platforms, and they basically gave a time window whereby every P2P lending platform would have to go and register with the FCA. Just some of the learnings and looking at the success there. It's come, and this is echoing the sentiment of this morning, in large part due to the government. The government themselves actually put £100 million of capital into these platforms to lend to small and medium-sized businesses or consumers as well. So, direct investment from government actually coming into these types of platforms in order to help the end consumers. They also went and created a tax incentivization program. So they created an ISA program. That would be the equivalent of a TFSA here in Canada, so a tax shelter, so that investors can actually invest in this asset class tax-free. That's really trying to promote people or savers to move their money out of savings accounts and into these types of investment products. And if you look at the impact, as I said before, over £7 billion has been originated since 2005. And one of the most interesting things I read was actually this speech given by Harriet Baldwin, who's was the UK Economic Secretary. She not only spoke about supporting P2P lending and supporting this industry as a whole, but they really talked about how this is going to be a vehicle to remove that mentality of too big to fail from the banks. And I think that's a very interesting perspective to look at it from policymakers' perspective, because that's a problem that's not new to 2000 plus. That's been around for 100 years. And I'll just very briefly touch on New Zealand. So very similar story in New Zealand. The FMCB passed the bill in order to kind of create regulation around peer-to-peer lending there. They created 2 new lines of regulation. They created crowdfunding regulation and peer-to-peer lending regulation. So just to conclude, why is Canada lagging? So why is Canada in the position that it's in today? I think lack of government support, echoing that sentiment very much, in 5 key areas. So the first is the government actually created a bank referral program. So they mandated that every single bank that does not provide financing to customers actually refer those customers over to another platform that can service those customers. The second, again, that Michael spoke about before, is actually providing open access to banking data. The third is that investment promotion, so tax sheltering. The fourth is actually that direct investment, so the £100 million plus investment that's been made in platforms. And the fifth is actually the vocal government support. You saw the Prime Minister, the Treasurer, various ministers of parliament actually speaking publicly about the need for this type of financing, the need for this evolution in financing, which really actually helped a lot of these companies get a lot of reputability in a market that, reputation is everything. So just to kind of close off in terms of Lending Loop, I think all of our data, just so you know, is publicly accessible. So if you want to take a look at our site, you can go to lendingloop.ca/statistics. We show all of the information that we actually have available to everybody, so you can see how many loans we've originated, what the characteristics are of those loans, what the loan performance is. And I think the message that I would leave you all with is we don't need to reinvent the wheel. I mean, I spoke a bit about how we're behind from a regulatory perspective, from a policy perspective, from a government perspective. A lot of the regulations and things in place have already been created, and I think it's great that we can look at other jurisdictions to get ideas on what we can be doing in Canada as well.